Welcome to a live market update. So, as expected, the Federal Reserve increased the interest rates by 0.25%. Now, what does that mean? Keep in mind, in our previous stories and market updates, we mentioned what it means to increase the rates. In short, these are short-term variable interest rates. We can go on, in a much more details about those rates. But what you need to know is that essentially it affects the short-term variable interest rates, things like credit cards, student loans, car loans, things like that. So, in a more important a question or update from the Federal Reserve was their summary of economics. So I want to show you guys. This is a number that really stood out to me as one of the most important data points from the Federal Reserve's meeting. So Fed fund rate, they are anticipating that at the end of this year, they're expecting this rate to end at 1.9. Now, in previous expectations or estimates, I had this rates at about 1.7, 1.8 over the course of the year. So what does this mean? This means that at the end of this year, the Federal Reserve is expecting the Fed's fund rate, the one that was just increased to 0.25%, to be at 1.9. Now, the Feds have about 6 more meetings left before the end of the year. So if they're going to increase at a quarter of a percent, and the rest of the year, that puts them at about 1.75 in December. So that stands to reason that there's going to be at least one or two meetings where the Federal Reserve increase this interest rate a little bit more than 0.25%. So I think that's key, right? It's important to note that the Federal Reserve is expecting to continue to increase this rate as a reaction to slow down inflation at a pretty steady rate, right? They're not going to pull the rug from under us and suddenly jump from 0% to a quarter to then 2% or 1.9. So it stands to reason at 1.9 at the end of the year, it's going to be a steady increase the rest of the Fed's meeting. So with the Federal Reserve rates going up, short-term variable rates, we can see the reaction in the bonds market, and we can see how the mortgage rates essentially have reacted to this news. Now, keep in mind, we've expected the mortgage market to price in the Federal Reserve hike, and even though it doesn't affect the mortgage rates directly, it still affects the overall interest rate market. So we can see the 10-year bond take a small decrease today based on the past couple of days where we've seen a steady increase. Again, if we zoom out over the past 3 months, we've seen this 10-year Treasury bond steadily increase. So, and at this dip here, I quickly got on the phone and I did a market update on YouTube as well. And I suggested that if you were in the market to buy or to refinance, it would be a good time to lock in your interest rate. And we can see here, it was the perfect time to lock over the past, given the anticipation over the past 2 or 3 months and what we're seeing going forward and so forth. But then again, rates going up, Federal Reserve rates are up 0.25%. Inflation is still almost at 10%. So it stands to reason the question, which is it a good time to buy? Now, in my opinion, I think a better question is it a good time to continue to be a tenant? So when we see the inflation rate continue to rise, we also see that rents are continuing to rise. Down here in South Florida, on average, about 20 to 21% year over year. So if you were to buy a property instead of renting, at least you're locking in that mortgage payment. Your principal and interest payment will be fixed for 30 years or however amount of time you lock in for, but it's locked. That's the point. It's a hedge against inflation. It doesn't matter whether inflation going forward is 10%, 5%, 20%. Your mortgage payment is locked in to where your rent payment is not locked in. The landlords are continuing to pass on the increased cost onto the tenants, and the tenants are essentially the ones who suffer in a high inflation market. So whether it's a good time to buy or not, ask yourself, is it a better time to be a tenant? So here's what not to do going forward. If you are a tenant and you're able to buy, don't run out and pay off or pay down your credit cards without us taking a look at your credit report first. And the reason for that is paying down your credit card debt doesn't have as much as a positive effect on your buying power as you may think. So you may be paying down credit cards that you really don't have to pay down to qualify. Moreover, paying down certain credit cards affects, or certain debts for that matter, affect your credit score more than others. So what we do during the pre-qualification stages, once we're looking at your credit, we essentially do a mini credit clinic where we can point out and give you a roadmap, a checklist to follow, where from experience, we've seen positive results, of the highest positive results, if you pay down certain debts over other debts. So it's important that before you run off and pay off any credit cards, any debts, and so forth, have us take a look at it first, just so that we can sit together and brainstorm and create a roadmap to increase your credit score as much as possible. Then also keep in mind, paying off certain debts does not have as much of a positive effect on your qualifying power as you may think. So before doing that, make sure that we take a look at your credit. Another point to not do during a high inflation or rising inflation market is don't renew your lease. Before renewing your lease, let us take a look at the possibility of you qualifying for a mortgage. Keep in mind, if you buy as a first-time home buyer, single family house or a townhouse, your minimum down payment is just 3.5%. If you're in the market for a condo, it's just 5% down. Now, in some cases, you can do 3%, but it depends on your income. Fannie Mae has some income limits and so forth, but in general, 5% down is the minimum for a condo. So if you're currently living in a condo, leasing in a condo, it may be a good idea to look at comparable condos for sale in the area, and then have us take a look and estimate your closing costs, your down payment, and your monthly payment. Because more often than not, you may end at a better place buying a similar or a comparable condo to where you're renting, instead of renewing your lease. And if you don't renew your lease, you can also use that money, your security deposit, for your down payment. You can use that money for other costs, closing costs, etc. And there are some programs and some cases where we can have the seller, we can have the county or the city pay for your closing costs. So then at that point, you're essentially only responsible for 5% down in a condo or 3.5 in a townhouse or a single family residence. Keep that in mind. Have us take a look at your pre-qualifying or qualifying power before renewing your lease. And the last point I just want to mention, in a rising rates, high inflation market, don't try to time the market. It's incredibly difficult to time the market, whether it's in stocks, crypto, real estate. First, you have to determine what your strategy is. Is your strategy for real estate medium to long term? And if it is, then whatever the market does in the short run doesn't matter. If you're going to build wealth over time, meaning adding properties, maybe one per year, two per year, etc. If that plan is medium to long term, it doesn't matter what the markets do in the next year or two. You won't be in the market to sell your property at that point. Your plan or your goal is medium to long term. So it's important that you don't sit on the sideline continuing to rent, continuing to pay for someone else's investment, trying to time the market. Just determine what your investment strategy is. If your investment strategy is medium to long term, and it doesn't matter what happens in the short run with real estate prices, whether they come down or up, your strategy is long term. So make sure you determine and you understand what your investment strategy is, write it down, and we can have a conversation about what we need to do, or what you need to do to qualify and get to your goals. So with that being said, guys, if you found this video helpful, please hit the subscribe button and the like button. Otherwise, until next time, see you. Be safe.